A one-person 401k is an excellent tool for self-employed individuals saving for retirement, as well as some partnerships where each partner can set up their own plan. These plans allow pre-tax savings, generous after-tax or Roth contributions, and that's without any income limits, and the ability to take loans if that's something you're interested in. A solo 401k, also known as an owner-only plan or a uni-K or an individual K, they're not nearly as complicated as large company 401k plans, but there are several technical details you need to get right, and these plans are new to most people. So, here are several tips for the busy business owner or consultant or freelancer to help you make your solo 401k experience as smooth as possible. One of the first things to know is that you must establish the plan by December 31st for most businesses. In other words, you have to do it by the end of your business's fiscal year, and most businesses use a calendar year, so that would be the end of December to at least establish the plan. And that confuses a lot of people because other accounts, like a traditional or a Roth IRA, even SEP plans, simplified employee pensions, or an SEP for small business, those allow you to open an account for the prior year if you do so before your tax filing deadline. But a solo 401k has that year end deadline, and it could be your fiscal year if you don't use the calendar year. Opening up the account is the key step, or establishing the plan. You don't necessarily need to fund it or put any money into it by year end, but you do need to complete all of the requirements to open the account. And that might mean signing the documents that establish your plan. And it's probably a good idea to submit those to your 401k vendor so that somebody can verify that the documents are in good order and that your plan does in fact exist and that the IRS is going to recognize it. You can make your contributions to the plan or put money in it later after it's established, but here are a few things to know. Your salary deferral contribution, like your Roth or your pre-tax payroll deduction contributions, those need to go in by year end or shortly after. You have a little extra time because you can argue that the last pay period of the year doesn't get processed until a week or two into the new year, but this is a salary deferral or a payroll contribution, so it needs to be roughly when you would get paid. And so act like you're a bigger company. If you're just a one-person shop who does things informally, you need to say, look, payroll is usually processed about every 2 weeks, maybe monthly, and I should get it in as quickly as possible. Your profit sharing contributions can typically go in later, as late as your tax filing deadline plus extensions. That might be late summer in some cases if you file extensions. The profit sharing contribution is an additional pre-tax amount you can add based on your profits from the business, and it's totally optional. You don't need to make that kind of contribution if you don't want to. You don't need to make any contributions, really, but then what's the point of having a plan? Plus, the IRS could ask some questions if you establish a plan and never actually use it. For example, it's probably not unheard of for somebody to establish a plan with the intent of just taking a loan and repaying it. But I would suggest not doing anything like that. You really want to use these plans primarily for retirement savings accumulation. You don't want to do anything that might look like a sham to the IRS. Next is over-contributing, and this only applies if you work for maybe multiple employers or have access to multiple 401k plans. So if you have an employer with a 401k, it's critical to understand the maximum annual limits. For salary deferral, the limit on your 401k contributions is combined and it's per taxpayer. So it's not necessarily per 401k plan, it's per taxpayer or per person or per individual, per you. You don't get a separate salary deferral limit for each 401k plan. But if you're really hoping to save a lot, there are a few tips you can use. First of all, if you have different types of plans, you might be able to save more than just one annual salary deferral limit. For example, if you have your own solo 401k and your employer offers a 457, or maybe you're able to make additional catch-up contributions to a 403b plan, you can potentially save more than a single annual limit. Also, employer contributions might be counted separately. Previously, we were talking about your employee contributions. And with a 401k, Especially a solo 401k, you have both employee and employer contributions. So you can possibly receive substantial profit sharing contributions from your employer and then make additional profit sharing contributions to your solo 401k plan. Check with a CPA before doing any of that, and don't try to get too fancy with making up separate employers so you can contribute more. It might make sense to use a different type of plan instead. And again, we don't want to do anything that the IRS might view as a sham transaction. Next is hiring an employee. This isn't a mistake by itself, but you need to make adjustments if you start hiring, or you may need to make adjustments. Solo 401k plans are designed for self-employed individuals who have no employees besides a spouse. Depending on your plan setup and the employee arrangement with you, depending on who you hire and how it works, you might be able to exclude part-time employees, and that might be less than 1,000 hours per year, or those who are under age 21. That could help you keep things simple if you just have somebody working a few hours per week or during the busy seasons. But you need to verify what your plan document says before you assume anything. When employees cannot be excluded from the plan, you may need to make some changes. So you might decide to change your plan to include the employee, and that's a great employee benefit for a small organization to offer. The administrative costs to having a 401k plan will increase when you add employees, but it might not be as burdensome as you think. And there are a lot of great small company 401k providers out there. I'm happy to tell you about those. Your plan will also need to pass non-discrimination tests, and those ensure that your employee benefits from the plan and it's not just benefiting you, the business owner, that it's fair and helps everybody. The easiest way to pass non-discrimination tests is to offer a safe harbor contribution. And the simplest one of those is just a 3% contribution of the employee's compensation into the plan. And that goes to them 100% immediately vested, but it helps you to simplify your life and avoid those non-discrimination tests. We don't want to get in the weeds on bigger 401k plans. Just be aware that hiring may affect how your plan works, and you may need to change your setup if you add employees. Owning multiple businesses can also add some complication. So if you're hoping to carve out a business for yourself and avoid offering the plan to employees, that could be difficult or impossible. Or if you already own multiple businesses and you just want to do a 401k plan in one of them, particularly the one that would allow you to open a solo 401k, it might or might not be possible. IRS rules look at common ownership of multiple businesses, and those rules could require you to establish a plan for everybody you employ, even if you can arguably say you have some self-employment income in addition to your other business ventures. This is something you really need to talk with an expert about before you just open a plan for yourself and leave other businesses, other employees without a plan. Next, we have filing a Form 5500. This is an IRS form that you're required to file once your plan assets reach $250,000. So 401k plans are generally quite simple, but as the assets increase, you have to do a little bit of extra administrative work. There is a stiff penalty for failing to file that return. It's $25 per day, up to $15,000 currently, so definitely not something to miss. In many cases, your plan administrator or your CPA or some other service provider is going to do this for you. They're going to file that document. But your main responsibility is to make sure that somebody completes that task, and you need to keep copies of that document. So watch for that $250,000 mark and make sure the IRS gets the information they need. Next, we come to RMDs. These are required minimum distributions, or RMDs. This quick tip is for when you're age 70 and a half or you're approaching that. In a large company's 401k plan, you might be used to ignoring the IRS requirement to take those distributions while you're still working for that employer. There's some limited ability to skip RMDs, but those rules don't apply to certain people, and that's particularly business owners. And because you're more than a 5% owner of your own business, the exception most likely doesn't apply to you, and you probably need to take RMDs from your plan after age 70 and a half. So shifting funds to a solo 401k with the goal of dodging RMDs might not work out. Please contact me if there's anything I can do to help you with your 401k plan needs, whether it's a one person plan, or you've got employees, or you have other financial needs like help with planning or investments. I'm a fee only advisor, so we can work together without you needing to transfer your accounts, and I don't earn any commissions for selling financial products. Thanks for watching.